or unemployment. Underwriting. It is important in modeling life insurance liabilities to consider what happens when a life insurance policy is purchased. Selling life insurance policies is a competitive business, and life insurance companies, also known as life offices, are constantly considering ways in which to change their procedures so that they can improve the service to their customers and gain a commercial advantage over their competitors. The account given below of how policies are sold covers some essential points, but is necessarily a simplified version of what actually happens. So, for a given type of a policy, say 10-year term insurance, the life office will have a schedule of premium rates. These rates will depend on the size of the policy and some other factors known as rating factors. An applicant's risk level is assessed by asking them to complete a proposal form. Given information on relevant rating factors, generally including their age, gender, smoking habits, occupation, any dangerous hobbies, and personal and family health history, the life insurer may ask for permission to contact the applicant's doctor to inquire about their medical history. In some cases, particularly for very large sums insured, the life insurer may require that the applicant's health be checked by a doctor employed by the insurer. The process of collecting and evaluating this information is called underwriting. The purpose of underwriting is first to classify potential policyholders into broadly homogeneous risk categories, and secondly to assess what additional premium would be appropriate for applicants whose risk factors indicate that standard premium rates would be too low. On the basis of the application and supporting medical information, potential life insurance policyholders will generally be categorized into one of the following groups. So these are preferred lives. They have very low mortality risk based on the standard information. The preferred applicant would have no recent record of smoking, no evidence of drug or alcohol abuse, no high-risk hobbies or occupations, no family history of disease known to have strong genetic component, no adverse medical indicators such as high blood pressure or cholesterol level or body mass index. The preferred life category is common in North America but hasn't yet caught on elsewhere. In other areas, there is no separation of preferred and normal lives. So normal lives may have some higher rated risk factors than preferred lives, but are still insurable at standard rates. Most applicants fall in this category. Next goes rated lives, which have one or more risk factors at raised levels and so are not acceptable at standard premium rates. However, they can be insured for a higher premium. An example might be someone having a family history of heart disease. These lives might be individually assessed for the appropriate additional premium to be charged. This category would also include lives with hazardous jobs or hobbies which put them at increased risk. Uninsurable lives have such significant risk that the insurer will not enter an insurance contract at any price. Within the first three groups, applicants would be further categorized according to the relative values of the various risk factors, with the most fundamental being age, gender, and smoking status. Most applicants, around 95% for traditional life insurance, will be accepted at preferred or standard rates for the relevant risk category. Another 2-3% may be accepted at non-standard rates because of an impairment or a dangerous occupation, leaving around 2-3% who will be refused insurance. The rigor of the underwriting process will depend on the type of insurance being purchased, on the sum insured, and on the distribution process of the insurance company. Term insurance is generally more strictly underwritten than whole life insurance, as the risk taken by the insurer is greater. Under whole life insurance, the payment of the sum insured is certain. The uncertainty is in the timing. Under, say, 10-year term insurance, it is assumed that the majority of contracts will expire with no death benefit paid. So, if the underwriting is not strict, there is a risk of adverse selection by policyholders. That is, that very high-risk individuals will buy insurance in disproportionate numbers, leading to excessive losses. Since high-sum insured contracts carry more risk than low-sum insured, high sums insured would generally trigger more rigorous underwriting. The marketing method also affects the level of underwriting. Often, direct marketed contracts are sold with relatively low benefit levels and with the attraction that no medical evidence will be sought beyond the standard questionnaire. The insurer may assume relatively heavy mortality for these lives to compensate for potential adverse selection. By keeping the underwriting relatively light, the expenses of writing new business can be kept low, which is an attraction for high-volume, low-sum insured contracts. It is interesting to note that with no third-party medical evidence, the insurer is placing a lot of weight on the veracity of the policyholder. Insurers have a phrase for this, that both insurer and policyholder may assume utmost good faith, or bona fides in Latin, on the part of the other side of the contract. In practice, in the event of the death of the insured life, the insurer may investigate whether any pertinent information was withheld from the application.